Canada's economy is hitting the brakes. New data from Statistics Canada shows this country's gross domestic product flatlined in July and August, and early indicators suggest it'll be unchanged in September as well. If that happens, it will mean Canada's economy will show zero growth or potentially a contraction for the third quarter. Randall Bartlett is the Senior Director of Canadian Economics at Desjardins. Randall Bartlett, thanks for joining us.
Well, thanks so much for having me, David.
Okay, these GDP numbers for the third quarter, they appear to be below, well below the Bank of Canada's projection. How do you interpret this?
Yeah, so we've seen that we had the August data come out today. It showed, GDP didn't really change in the month, and Stat expects September to be the same. So when you tally all of that up, GDP by industry is expected to decline by about minus 0.1% annualized, and we had minus 0.2 the previous quarter. You stack that up against the Bank of Canada, which came out last week expecting third quarter real GDP to advance by 0.8% annualized. So big difference between those two numbers, and really suggests that the Canadian economy is more sluggish than the Bank of Canada expected just a week ago.
So if the GDP remains flat in September, we're going to have two back-to-back quarters of contraction. That's a recession, right? According to the textbooks, I mean, is that where the economy is potentially right now?
Yeah, I mean, it's sort of tough to say in the sense that when we actually run the data through our models, we're getting a small positive. So it's really Canadians should think about it as the economy basically stalling in the second quarter and third quarter of the year. When we actually think about what a recession is, it's not just the number of quarters and the fact you have two consecutive quarters of negative growth, but what also defines it is just how widespread it is in the economy. And really, that is becoming a bit of a risk. When you look at August, we had 12 of 20 sectors actually contract. So we may be moving in that direction. I don't know if we're ready to call it just yet, but certainly the results don't look very promising.
Does this in any way mean, Randall, that maybe the Bank of Canada overshot on interest rates? I mean, we're still seeing pretty high growth south of the border, where they're even talking about jacking rates up yet again. But, being below their projections, is it a potential they went a little bit too far? Is that where we could be?
Well, we saw the same thing happen in the second quarter when in July, the Bank of Canada was projecting Q2 real GDP growth of 1.5%. It came in at minus 0.2%. But even up to the day of the release, most economists were actually projecting something around the same range. What really changed things for the data was massive historical revisions as a result of things like wildfires and strikes and that kind of thing. So we really could get a bit of a surprise here that, the data has been revised so heavily coming out of the pandemic and obviously during the pandemic as well, that it's the underlying data itself just isn't quite as reliable in terms of what you can expect post revisions as additional data comes out.
No, you make excellent points about the impact of the wildfires and like the Port of Vancouver. There's serious knock-on effects from that on the margins from a positive to a negative very easily could have that kind of thing. So based on what we can divine from the data, as unreliable as it may be because of those caveats, and where interest rates are, I mean, what's your anticipation for 2024 for the Canadian economy? What does the next year potentially look like?
Yeah, so we think that we're seeing the Canadian economy really start to feel the weight of higher interest rates. I mean, those hikes started in March of 2022. It takes time for them to feed through into the economy, and we're seeing that that weight continues to put downward pressure on economic activity in Canada. When you think about it in terms of GDP per capita, we've actually seen that growth has been declining almost every month for the last year. So really, the surging population growth that we're seeing in Canada is providing a bit of a false signal as to what's happening at the aggregate level. And there's a lot of weakness actually under the hood when you look at it on an individual basis or per capita basis here. And going forward, we think that pressure from higher interest rates and still elevated inflation as well is just going to continue to put downward pressure on economic activity to the point that we're likely to have a short, shallow recession in the first half of 2024 that's broad-based across sectors, as Canadians really need to cut back on discretionary spending in order to make sure that they can make those higher mortgage payments as mortgage renewals just keep on keeping on.
I've seen a lot of people talk about the low GDP per capita as a sign of a structural weakness in the Canadian economy. Is that just because of low productivity, low output, or is this an aging population where people move out of the job market, aren't working or are working less than full time? I mean, what's driving that particular data?
Well, we've written on this quite a bit at Desjardins. It's interesting. It's a little from column A, a little from column B, in the sense that we've seen very weak productivity growth in Canada since oil prices dropped significantly in 2014, 2015. And as the economy has continued to rebalance away from mining and oil and gas extraction toward other sectors,
Right.
we just haven't seen the productivity growth in other sectors that's helped, would help to boost living standards in Canada. Also, during the pandemic, we had the shock of people losing their jobs, but also a lot of people retiring and moving out of those positions. And now we're bringing a lot of newcomers to Canada to fill those roles, and we're still seeing a lot of labor demand. But certainly, we're not seeing the productivity growth to go along with that surging demand, particularly in temporary labor.
Okay, just one simple question before we let you go. Is this the end of the rate hikes for the Bank of Canada? Do you think the next thing we're going to see is a cut? Where are we on that?
Yeah, we think this is the end of the rate hikes for the Bank of Canada. Growth continues to surprise to the downside for the bank, and so we think that that's going to help to put downward pressure on the labor market, downward pressure on underlying inflation, and ultimately support the Bank of Canada cutting rates starting in the middle part of 2024.
Okay, Randall Bartlett, Senior Director of Canadian Economics at Desjardins. Thanks for your time today.
My pleasure. Thanks for having me.